Good morning, everybody. It's great to see so many people of you here today. I hope you have enjoyed the first presentation and also will enjoy the rest of the day. As Armando mentioned, my name is Peter Hafez, and I'm the Chief Data Scientist at RavenPack. I run the internal team that looks at our own data. So we sit as an internal client, consuming the data as our clients would consume it. And we try to come up with various ideas and concepts and write research reports around that in order to inspire the marketplace on how to take advantage of our data. It's kind of become a little bit of a tradition for us to present some of our latest or current research that we are doing in the team and at our conferences, and today is no different. Today I'm planning to talk about new sentiment everywhere, and more specifically, I'm going to focus on global equities. So I think we all know that the asset management industry has been under enormous pressure in recent years. And we have seen more traditional alpha sources decaying faster than what they have historically. And that, of course, has put a lot of pressure on asset managers in the sense that it's been harder to manage the same level of AUM with the same performance as you could in the past. And to address this issue, you can see more and more managers having turned to alternative data to see if we can find new sources of alpha that will allow us to keep that same sort of scalability in the strategies that we develop. We have also seen a tendency amongst our clients that more and more expanding their mandates from trading local to going more global. And that's, of course, another way of trying to create more scalable strategies. If you look at alternative data, it may be the answer on the data side, but where alternative data may have some challenge is in global coverage in terms of regions and in terms of companies. A lot of alternative data sets are very narrow, so they may be focusing on particular sectors or particular markets. And there's no doubt that there are more alternative data sets available for US markets and to some extent also across Europe, where Asia Pacific is more challenging. News analytics is not one of those data sets. I mean, in news analytics, we have true global coverage. And that's part of some of the things that I will talk about today. How does news analytics perform across various regions such that it can help you in building these more global mandate type portfolios. So for those of you who don't know what news analytics is, I thought I wanted to start out with a quick overview. So news analytics is really about turning unstructured content, text, primarily news and social media, of course, into actionable analytics. And at RavenPack, we do that focusing on some key attributes. First of all, we look for entities in the news. That could be companies, it could be people, it could be products, places, organizations, currencies, or commodities. So we are truly a global asset class type of data set. We also look for events. So we're trying to look for context in which those entities are mentioned. So we cover about 7,000 actionable events in the news that map into a broader taxonomy. It could be anything related to business, economy, political, societal, or environmental news. At the most granular level, as I mentioned, we have 7,000 categories. It could be, earnings above or below expectations, news about earnings guidance, companies laying off people, firing the CEO or hiring a new CEO. But it could also be about, more economic guidance, GDP guidance, and so on. We also will tell you how relevant the entities are, companies, but also the events within the articles. Is the company or the event mentioned in the headline, or do you have to dig it out deep in the story body? And that, of course, has implications for how predictive these type of records or signals will be. There's no doubt that if you look at large cap US stocks, they tend to be very much headline driven, where you have to go deeper into the story body as you go down the size scale and, let's say, move into a small cap universe. But whether you want to trade headlines versus deeper story body event detection also depends on the event categories that you're trading. Right. The other thing that we also look for is the novelty of the event. And depending on your particular use case, you either want to only include the most novel event in your strategies, but it could also be that you're interested in capturing buzz and therefore wants to look at how widely disseminated some particular event is across multiple sources and how much coverage it generally has, to see if that could be an indication of how impactful it might be. And then finally, and one of the things that we are best known for, as Amando also mentioned, is sentiment. But we don't believe as a company in one sentiment score to capture it all. We believe in multiple sentiment dimensions. So we have applied various sentiment techniques. Some of them are event aware and are based on surveys across the panelist of a panel of analysts. We also have what we call more traditional technique like bag of words or base classifiers. And the reason for why we have this is that different sentiment scores are, can you say, important in for different strategies. If you look at event sentiment, it tends to have the highest immediate impact, of course, because it's very event-driven, but it tends to decay fairly quickly. However, as you go to some of the more traditional classifiers, it may start out a little weaker, but the decay is slower. So depending, again, as I mentioned, on your applications, whether you're looking to build shorter-term versus longer-term alphas, you may want to look at various sentiment techniques. So RavenPack has been around for more than 15 years by now, and we have operated as a product company for more than 10 years. And over the years, there's been quite a bit of research done on our data, not only by ourselves, but also by third party, both by academics as well as sell-side researchers. As I mentioned, I will talk about a global study, but there's been also other studies done looking across the global economies. We have seen more recently JP Morgan doing research on our data, and Ada will talk about some of the research that they have done. They have covered the Japanese market as well as the US markets with our data. We have seen Deutsche Bank working on pairs trading strategies, covering in Europe and the US as well. And Macquarie has done quite a bit of research in the Asia-Pacific region, as well as in Europe and in the US. We are kind of expanding on some of this research, bringing it more up to date, and perhaps looking at some other horizons than what they were covering in the papers. Macquarie, for instance, focused mostly on monthly horizon. We will move into multi-day horizons in the study that I will present just in a moment. So if we take a stab or take a look into the research that we're currently doing, well, we basically create a set of simple benchmark type strategies based on sentiment. And we focus on a large and mid-cap universe of companies globally. Our universe is large and mid-cap within the Russell Global universe. Our objective is really to show how new sentiment works everywhere. So we're covering 47 countries across 5 regions. We built our sentiment indicator by taking a simple sum of RavenPack's event sentiment score, ESS. So it's basically a way of combining both sentiment direction as well as volume. So of course, companies that have more volume will also have more extreme scores, generally. We have also done some experiments by removing, let's say, a cross-sectional mean on a daily basis, and that also seems to provide some value. We take our sentiment snapshot once a day, specific to each exchange that we are covering. We look at 54 different exchanges. So we take a snapshot 30 minutes before the close of the exchange, and then assume we can trade on the close. And then we kind of hold for fixed holding periods, 1, 2, 3, 4, 5 days into the future. We start out and build, can you say, our portfolios at country level, and then we roll it up into either region or global portfolios at the end. And we use the relative market caps of each region, or each country, sorry, as a weight for how much you contribute to the regional or global portfolios. And in terms of the market cap, we look at the past 21-day mean market cap, or average market cap. So this is what it looks like on a global heat map. We find positive performance in 42 of 47 countries. And 1/3 of performing countries, we're able to get information ratios above 1. Of course, some economies, there will be more diversification than in other economies, and therefore, there can be a wide spread between the information ratios you can get in each individual market. If we look at the non-performing countries, that's obviously also interesting to take a look at. The 5 countries are Iceland, Norway, Peru, and Hungary, and the most negative information ratio we get in Pakistan. I will also say it's a very small portfolio. There's not a lot of large and mid caps in Pakistan. And what we see is actually a negative Sharpe of 2. So it could perhaps indicate that some of the sources that we are looking at may be delayed and you're kind of capturing perhaps more of a reversal effect. But as I mentioned, it's based on very small portfolio, so it could also just be some sort of randomness in that result, even though -2 is quite large or extreme. So here we have kind of, instead of focusing on the bottom 5, we kind of tune in on the top 10 economies where we see some good performance. And we have tried to plot it on a timeline, and as you can see, or as an equity curve. And as you can see, performance is quite consistent over time. And if we look at the top 10 countries in terms of information ratio, we're also seeing that 9 of those top 10 countries or economies also rank in the top 10 when it comes to annualized returns. In terms of performance, it can perhaps be a little hard to see for everybody. We see at the very top Hong Kong performing very well with an information ratio of 3. Canada is coming in second, Singapore, Australia, the US, Japan, Switzerland, the UK, Germany, and then the Philippines. So it's a quite wide mix of well-performing countries, and basically more or less all regions are represented in the mix of the top 10. We have also tuned in on just looking at the performance over the last year or year and a quarter. We are looking up until including first quarter of 2018, just to see how performance has been, especially also focusing because that is what you would call perhaps strictly out of sample, in the sense that the version of the data that we have been working with were launched back or in end of 2016, early 2017. So this is, can you say, data that has been generated in real time. And as you can see, performance has been very, very strong still in 2017 and onwards, with US having performed the best with information ratio of 2.6 on an average portfolio size of 300 companies. Japan has also done well. Hong Kong, Canada, and the Netherlands have also been very good markets to trade over the last year. I will mention here, and probably I haven't highlighted it strong enough, this is based on one-day holding period, so of course you have some fairly high turnover strategies. So the challenge becomes how do you implement it, right? But I will try and address the holding period a little later in the presentation. This is what it looks like when we roll up the performance to regional portfolios. And as you can see, all regions show positive performance. 3 out of the 5 regions have information ratio above 2. Which seems quite attractive. And the least performing regions are the Middle East and Africa, as well as Central and South America. And the primary driver here is coverage. We just don't have as many signals. We do have the company coverage, but there's just not as many events being detected that would generate signals for us in this particular strategy. This is what it looks like from an equity curve perspective. Again, you're seeing Asia Pacific is doing really, really well, close to 3.7 in information ratio. North America and Europe also doing well, and you have pretty decent sized portfolios here. We also, at the right-hand side in the smaller table, have shown the performance from 2017 and onwards, also showing very, very strong performance. One of the things that we wanted to do was try to look at the decay as well, because the strategies that I've kind of highlighted up until this point is very short term. So now we try to see what is the decay of the signal. And we try to evaluate that looking at the information criteria, the AC. And we look at it both on a cumulative basis as well as on a shifted or a lag basis, right? And what we find is that the highest IC, not surprisingly, you get with just a one-day kind of holding period. However, all of or most regions show positive lag IC even 5 days out, and all regions have positive cumulative IC up to 1 month out. If we try to use this information to create a signal where we hold the signal a little longer, we'll get the performance measures that you're seeing in the table below. And especially for Asia and Europe, you can see that you are still able to get information ratios above 1, even 1 month out, where North American markets, you kind of breach the one information ratio of 1 threshold after about a week. What's also interesting to notice is that performance across Middle East and Africa is pretty stable over the period, and you kind of start to benefit a little bit by more diversification as you hold longer portfolios, because of course the portfolio size kind of builds up as you force longer holding periods. And finally, this is when we try to build it up or include all of it into a global portfolio. And here we are focusing on holding periods from 1 to 10 days. You're seeing very high information ratios of 4. As I mentioned before, it is a very high turnover strategy, so the challenge becomes how to implement it. But we can still see that even with 2 weeks holding period, we are at information ratios of about 1.3 and portfolio size of about 1,800 companies on average. Again, if we look at 2017 and until end of Q1 last year, we can see actually that it looks like the signal has slowed down, in the sense that we can go out to 4-day holding periods and still have or achieve an information ratio of 4, and even with 2 weeks holding periods, we are close to 2.5. So it looks as if the performance of the data is still going strong. So just in conclusion, and then I will open up for a few questions, what we have been seeing is that in order to maintain or increase scalability, asset managers have been turning in a larger and larger extent towards alternative data, and often combined with an expanded global mandate. And news analytics provides a very strong support in these efforts, as I have shown here, that it works quite well across multiple regions. And as you can see, it's performing particularly well in those regions that are also the most liquid to trade. And over the years, and with all the research available, news analytics in particular has proven itself with some strong use cases in finance, and the market is kind of starting to wake up to the idea or realizing that it's becoming more and more of a must-have to look at these type of data sets as part of the investment process. That's it from me. If you have any questions, I'm more than happy to answer them now, or I'm also available during lunch break.
Yeah, on the data you just saw of information ratios going out few weeks and the improvement over 2017 for those numbers, you don't adjust for the market.
The market, sorry?
You don't adjust for the Sharpe ratio of the market or the exposure to the market, right? Because 2017 had a far better Sharpe ratio for the global equity market. So isn't that what you're just picking there?
So what we're doing here is that we are evaluating in excess returns. So we do remove the individual market average when we build the portfolios. There's no, can you say, neutralization for factors, but generally what we find is that our strategies, our signals, hold a low correlation to traditional factors at these very short horizons. And in fact, when we have done studies on, let's say, removing factor exposures, let's say including a MSCI risk model or something like that, what we see is that it doesn't really take a lot away from performance, but it does reduce the volatility of the strategy. Thanks.
Peter, thank you very much.
This is RavenPack.